8% more than Treasury bonds. That's not very much. If you bought a BBB rated mortgage bond, it paid 133 basis points more than a Treasury, which means 1.33%. So it's more than 10 times as much return on a BBB rated mortgage bond as a AAA rated mortgage bond, which shows you what these reckless, greedy bankers were passing up by buying AAA rated bonds instead of BBB rated bonds. There are two other main pieces of evidence against the theory that bankers were being reckless and greedy, whether the alleged reason for that is the bonuses they were being paid or the fact that they supposedly knew that they were too big to fail. One of them is that there's something that's even safer and pays even less than AAA rated mortgage bonds, and that is bonds issued by Fannie and Freddie. Since Fannie and Freddie were congressionally chartered and were widely considered really to be too big to fail because of the fact that they were creatures of the federal government, they paid even less, 2 basis points less at the end of 2006 than AAA rated mortgage bonds. U.S. banks held 4 times as many Fannie and Freddie bonds as they held any kind of privately issued mortgage bond. The privately issued ones were the ones that had ratings. Fannie and Freddie, since they were government, quasi-government entities, were considered to have an implicit AAA rating, but it was thought to be even safer than a real AAA rating. Yet banks held 4 times as many of them as they held private mortgage-backed bonds. The other thing is that without getting too deeply into the way that bank financing works, leverage is borrowed money. And most of what banks lend out or invest, they first borrow. The amount of borrowing is called the leverage ratio, and despite the fact that a myth is out there, even among experts, that banks leveraged up, meaning borrowed more money, which is, of course, risky in the run-up to the crisis. In fact, no matter how you measure leverage ratios at American banks were flat during the whole decade of the 2000s. So the initial theory about the crisis having been caused in some way or another by reckless, greedy bankers who borrowed as much money as they could in order to make as much money as they could is just factually incorrect. In fact, what these 3 pieces of evidence about the low payouts to AAA-rated mortgage bonds, the high quantities of Fannie and Freddie bonds that banks had compared to their privately issued mortgage bonds, and the fact that leverage was flat suggests that actually bankers were risk-averse, not risk-seeking. That's why they were buying these super safe and yet super low-paying bonds, both from Fannie and Freddie and from investment banks that have been rated AAA. So now that's what I'll say for the moment about the financial crisis itself. But the reason that I got interested in this is that I was a libertarian activist, libertarian student activist about 30 or 40 years ago, and I became a scholar because I wanted to see scholarly treatments of the question of whether capitalism is overall a good thing, and whether it should be regulated or in other ways modified by government. And that's still what my primary interest in the financial crisis was. So what does this tell us? What does this pattern of risk-averse investments that the bankers made tell us about capitalism, if anything? I think the first thing that it tells us is that they were ignorant of what was coming, just as almost everybody was. They were ignorant of the fact that by buying any kind of mortgage bond, they were investing into a housing bubble. As late as 2006, Ben Bernanke was assuring everyone that there was no nationwide housing bubble, and that is what pretty much everybody believed. There had never been a nationwide housing bubble, and what everyone thought right up until the bubble started deflating was that there were local housing bubbles in hot cities not just literally hot, but places that lots of people would want to live in, like Miami. But it wasn't a nationwide housing bubble. One of the things about mortgage bonds is that they were often geographically diversified to ensure against the possibility of local housing bubbles. So bankers are human and fallible, and in this case they were ignorant and they made a mistake in buying these mortgage bonds even though they bought the safest type that were available. So that tells us something important about capitalism, which is that it's staffed by fallible human beings. I don't think our attitude toward capitalism should be worshipful of heroic entrepreneurs who are somehow more omniscient than any other human beings. If that were the case, not just bankers, but businesses in general would never lose money, and of course they often do. So this would seem to be bad news for capitalism, except in as much as it relieves bankers of direct responsibility for having caused the crisis because they were so greedy. But I think that this whole tendency to analyze capitalism in general and the financial crisis in particular in terms of motives, in other words, how greedy were the bankers, is a mistake. It's a mistake that's encouraged by economists. I think that Austrian school economists to some extent can rightly say that they're an exception to this because they recognize a role in economics for human ignorance, which is what I think basically explained the financial crisis. But even Austrian economists tend to focus too much on incentives for my taste. Incentives are motives. The motive is self-interest, and for something to create an incentive to do something else, the people in question have to be motivated by self-interest in order to want to take advantage of the incentive. I don't think that the financial crisis is really susceptible to that type of simple, straightforward incentives analysis, and I think that the too big to fail theory and the bonuses paid to greedy bankers theory, those are both examples of simplistic incentives analyses that are still commonplace among economists who write about the financial crisis. It's so self-evident to economists because of the training that economists get that everything or almost everything can be explained by incentives, that as soon as people began proposing these various incentives-based theories of the crisis, they were just accepted as obviously true by most economists and then by most journalists and now by most members of the public. So there's a lesson, there are lots of lessons from the financial crisis, but one of them is about how we think about capitalism from an analytical point of view rather than a normative point of view. Is it a good thing or a bad thing? We have to factor in knowledge questions and therefore ignorance questions as well as incentive questions when we think about capitalism. Now back to this grand comparative question that I've been interested in ever since I was a libertarian student activist, about capitalism versus the need to regulate it or modify it in some way. It would seem to be bad news for capitalism that the bankers who bought mortgage bonds didn't realize that they were investing into a housing bubble. But the fact is that the same thing is true of the regulators. They too are human, and in this case they too were ignorant of the very thing that the bankers were ignorant of. Not just Ben Bernanke. One of the things that's important to know about the financial crisis and about banking in general, despite all the talk about the deregulation of banking because of the repeal of the Glass-Steagall Act, the repeal of the Glass-Steagall Act actually was a repeal of part of the Glass-Steagall Act. The Glass-Steagall Act, the part of it in question had forbidden commercial banks, which are the type of banks you deposit money into, from having investment bank arms, because investment banks are more speculative. They advance money to companies that are going to have an IPO, for instance. When in Engineering the Financial Crisis, my co-author and I, Vladimir Krauss, we dismiss the role of investment banks as being relatively unimportant because what we're interested in, what everyone is interested in about the financial crisis, is the fact that it caused the Great Recession. investment banks aren't in a very good position to be causing a recession because of the fact that they don't lend money into the economy. They lend into the real economy. They don't make mortgage loans. They don't make commercial loans. They don't issue credit cards. And they don't make business loans. That's what so-called commercial banks do. So it is true that investment banks were relatively unregulated, and this had nothing to do with the Graham-Rudman repeal of part of the Glass-Steagall Act. It had to do, I'm sorry, not Graham-Rudman. It had to do with the fact that investment banks are not insured by the FDIC, and so they've been relatively lightly regulated. But ever since the Great Depression, commercial banks have been heavily regulated by the FDIC in the United States, as well as other regulatory bodies like the control of the currency and the Fed. And this has been true around the world. The reason is that when deposit insurance was instituted during the Great Depression, it was thought that now that bankers were not incentivized to be careful by the fear of a bank run, because deposit insurance basically ended bank runs, now the bankers are going to be reckless and greedy and will make wild speculative investments. And if they did that, then the FDIC would have to bail out their depositors and the FDIC would go broke. So the federal government started regulating commercial banks. This was done all over the world, not in every single country, but in most countries eventually. And by the 80s, there were all sorts of different regulations of commercial banks all over the world. And the primary means of regulation were capital adequacy regulations. Now here I have to get very briefly into a little bit of detail about the way banks raise money to make the loans and other investments that they make. There's capital and there's debt. So a bank can issue bonds. That means it is owing money to people, the bondholders, in return for the money that the bankers get, and then lend out to other people to buy houses with or to start businesses with. Debt is dangerous, of course, because you might not be able to pay the money back. Then there's capital, which is where you issue stock, and you're not really under any debt obligations when you issue stock. The stock owners have a right to ownership of whatever is left after the creditors of the company, such as the bondholders, are paid off. So banks have two primary forms of becoming indebted. One is that depositors make deposits. The banks take the deposits and lend them out as mortgages or business loans, or they make other investments with it, with those funds. But of course, they owe those funds back to the depositors if the depositors should ask for the funds back. And the other is to issue corporate bonds. The banks actually issue corporate bonds. So one of the things that it was thought after deposit insurance was instituted that bankers would do, because they would be reckless and greedy, is borrow up to the hilt so that they could then lend out this money in speculative investments that might have a potential high payoff, higher than the amount that they would owe to their depositors or to the bondholders of the bank's bonds. So all over the world, the regulation of banks primarily took the form of making sure that banks had a minimum capital cushion. And in 1988, the world's banking regulators got together in Basel, Switzerland, and they came up with a uniform system of regulating banks' capital. Without going into the details of that, I'm just going to fast forward to 2004 when the second version, Basel II, was promulgated. Basel II was in effect at the beginning of the financial crisis in Europe. It goes into effect country by country according to the preferences of that country's financial regulators. It did not ever take effect in America, but a version of Basel II that's relevant to mortgage bonds took effect in the United States even before Basel II was promulgated. In 2001, this regulation was enacted by the Fed, the FDIC, the controller of the currency, and it was called the recourse rule. So what the recourse rule did in the United States in 2001 and what Basel II did in the rest of the world after 2004 was, without going into the details, it penalized banks that did not make investments in AAA or AA rated mortgage bonds. In other words, the regulators thought reckless, greedy bankers, it's our job to regulate them and make sure they don't become too reckless because they're so greedy. Therefore, we should force them or encourage them by penalizing them if they don't do what we want. We should penalize them for not investing in ultra-safe assets. And AAA mortgage bonds were considered ultra-safe assets. That's not just because Standard & Poor's or Moody's rated them as being AAA as a matter of opinion. Unlike when Standard & Poor's and Moody's and Fitch rates corporate bonds or sovereign bonds, meaning government bonds, the ratings of mortgage-backed and other asset-backed securities are actually tied to the legal structure, the contractual structure of the bond. A mortgage bond is a pool of hundreds or thousands of individual mortgages, and all the money that is generated by that pool when people pay their mortgages, first it goes to the AAA bondholders, and until every penny that is the AAA bondholders have a right to has been paid to them, AA bondholders don't get a cent. Then all the AA bondholders are paid off, then all the single A bondholders, and so on down the line as you get into junk bond territory. So there really is a legal contractual basis for saying that a AAA bond, a AAA mortgage bond is much safer than a AA bond, and that's much safer than lower rated bonds are. So when the regulators penalized banks for not investing in these, they in a sense knew what they were doing. I mean, it was not an irrational regulation. It was not, as far as I can tell, in any way a case of banks or other special interests having their way with regulators or capturing the regulators. The regulators were supposed to be trying to get the banks to invest in safe securities, and these really were, other things being equal, and as far as the regulators knew, safe securities. What they didn't anticipate was that there would be a nationwide housing bubble, because there had never been one before. It's conceivable also that this, since banks are such big investors taken as a group, it's possible that this regulation actually helped to cause the housing bubble, because in order to have AAA mortgage bonds, you need a lot of mortgages. So since the regulation pushed banks away from business lending, which declined after this regulation was passed, and toward mortgage lending, and particularly mortgage lending where the mortgages were packaged into mortgage-backed securities, it may be that part of the demand for these mortgage-backed securities that was fed by unscrupulous mortgage dealers like Countrywide, part of that demand was banks that wanted securities that regulators wouldn't penalize. I can go into this in the question period if anyone wants, but the way that they penalized them basically was requiring banks to raise capital for what the regulators considered riskier investments, such as ordinary commercial business lending. So we have, from the perspective of what do we think about capitalism, we have a sort of standoff here. We had ignorant regulators, ignorant of the fact that they might be steering banks into what were actually unsafe securities in case there was an asset bubble in the underlying collateral of these securities, which in this case was mortgages. And then we had bankers who also were ignorant that there was a nationwide housing bubble, or they wouldn't have bought these securities even though they were penalized otherwise, because buying these securities turned out to be much worse than facing the penalties of not buying them that had been imposed by the regulators. However, we have ignorant people who are regulators, and we have ignorant people who they're regulating. There is a difference that came out with particular clarity in the financial crisis, though, between the mistakes made by regulators and the mistakes made by private sector actors. And that is that, almost by definition, a private sector actor has control over many fewer resources than the regulator does. The regulator controls all private sphere activity in that jurisdiction. all the banks in this case. Whereas each bank is run by different people who have different ideas about how risky housing is, for instance. J.P. Morgan Chase stayed relatively clear of mortgage bonds because the head of J.P. Morgan Chase, Jamie Dimon, was very suspicious about the safety of housing. He did suspect that there might be a housing bubble. Most other big bankers didn't. But if you look at the practices of the various big banks, even though I earlier told you that leverage ratios remained stable before the financial crisis, and the amount of agency, Fannie and Freddie bonds, dwarfed the amount of privately issued bonds, it varied from bank to bank because different bankers had different ideas about what was safe, what was risky, and despite the notion that just because there's deposit insurance, they don't care about going bankrupt, apparently they did, not only because of the aggregate safety of the securities that they bought, but the fact that when Jamie Dimon thought that housing was dangerous, he directed J.P. Morgan Chase not to participate in mortgage-backed securities. This kind of heterogeneous behavior is what we would expect if the world is complicated enough that it's somewhat ambiguous how to make money in it. Now, if it weren't somewhat ambiguous how to make money in it, then everybody who did anything in that world would make money. But lots of people lose money. So in this light, what you can say about capitalism is it's full of fallible people, ignorant people who will make mistakes, but other things equal, they will tend to make different mistakes. That's really, I think, the best way of viewing the competitive process of capitalism. It's a process of different people grappling with an uncertain world. They come up with different ideas about how best to do that. They compete with each other, and whoever turns out to be right makes more money. The positive systemic effect of that heterogeneity is that the risks that the society as a whole and the economy as a whole are subjected to are spread in different places or diversified by this heterogeneous behavior of different business people. I mean, the problem, of course, is that a lot of these business people are going to be making mistakes, and that's a waste, but that's the human condition. Now, when you have regulators trying to improve on that, what we are in effect relying on is that the regulators are going to be better informed, or that they're going to interpret the ambiguous situation better than the people that they're regulating. So the possibility is that they'll do that right, and the whole system will be better off. The danger, of course, is that since the regulators are human, if they make a mistake, they now impose that mistake on the entire system. The way that banking regulation worked in the case of the Basel regulations and the recourse rule is very instructive in this respect, because the regulators often will impose outright fines or jail sentences for breaking their rules, but in this case they simply impose financial penalties for breaking their rules. Nonetheless, the rules seem to work. We find in the book Engineering the Financial Crisis that banks had 3 times as much invested in AAA rated mortgage-backed bonds than other investors did, and the only at least immediate difference between the two types of investors is that only bankers were covered by these regulations that penalized them. They didn't invest in highly rated asset-backed securities. So our conclusion is that the regulations worked in the sense that the regulators wanted banks as a whole to move into these securities that seemed safer than other things that bankers could do with the money that they borrow. And so the effect of the regulation wasn't to completely stamp out heterogeneity, but it was to homogenize the system as a whole by skewing banks in the direction that the regulators wanted them to go in, because the regulators thought that direction was safe. So I think the larger lesson that can be drawn about capitalism from the crisis is that it's not a good way to deal with human fallibility. There's no real good way to deal with that, because people are simply going to make mistakes, whether they are regulators or whether they are the regulated. But it's a better system of dealing with human fallibility than trying to impose what seems like the perfect way of doing things on everybody. It may be the perfect way of doing things, because fallibility doesn't mean that we're always wrong. The regulators might get it right in a given case. But it's a tremendous risk to put all of the society's bets on the wisdom of the regulators. And I think we saw the disastrous effects of that kind of risk-taking, inadvertent risk-taking, in the financial crisis. From an analytic standpoint, as opposed to a normative standpoint, the narrative I'm giving about the financial crisis does have incentives involved in it, as you would expect in the economy, where self-interest is the primary motive, but not the only motive. But it is a motive, and you have to be self-interested to some extent, or act as if you were self-interested just to stay in business. So the banking regulations worked by offering incentives to banks to do what the regulators wanted them to do, which in this case was to buy highly rated mortgage bonds. But that's a very incomplete picture of what happened. If you just go with the incentives, you have a bunch of different incentives, such as the bonuses that were paid to bankers, the alleged knowledge among bankers that they would be bailed out if they made any mistakes. So it's not that these conflicting incentive stories can't be resolved by using evidence, but I think that once we use the evidence and analyze the financial crisis, at least, what we find is that the incentives don't explain everything. What is really important about the financial crisis is why it ended up so disastrously. And in order to understand that, you not only have to understand the incentives created by the regulations, but you also have to understand the fallibility of both the regulators and the regulated. But the fact that human fallibility works differently when you've got a bunch of different people who are fallible competing with each other, as opposed to one group of people imposing one set of answers on everybody. That's it.
Okay, thank you, Professor Friedman, and to all of our participants. Please type any questions into the question box, and I will read them to Professor Friedman. And looks like we have some questions that came in already. Who gives the AAA ratings, or ratings in general, for the mortgages?
Well, there's an interesting story there. The short answer is that there were at the time of the financial crisis, three so-called rating agencies, which are actually private companies: Standard & Poor's, Moody's, and Fitch. The interesting story is that also starting in the Great Depression, all sorts of regulations began to be passed at both the federal and the state level, which, like capital adequacy regulations, were designed to make for safety. So pension funds, for instance, were required to never buy junk bonds, to buy highly rated bonds only. And there are all sorts of regulations of that sort that proliferated starting in the 30s. By the 70s, there were so many regulations that required high ratings for various types of investor that the SEC issued a regulation that basically said not anybody can set themselves up as a bond rater, because then the purpose of all these regulations could be defeated. So only the existing bond raters, which were Standard & Poor's, Moody, and Fitch, counted as nationally recognized statistical rating organizations. And the SEC basically protected that cartel of three all the way up to the financial crisis. In my initial thinking about the financial crisis, when I wrote the introduction to the Critical Review special issue and to the book, What Caused the Financial Crisis, I emphasized this a lot. Now I'm not so sure how important that was, because of the fact that I'm not even sure that the ratings were wrong, as it turns out. It's hard to tell, but AAA mortgage bond investors, according to the Financial Crisis Inquiry Commission report, had only taken a 1% loss at the time that report was issued a couple of years ago. Now, that might in part be because of all the bailouts, especially bailouts for mortgagers, that may have prevented more defaults from hitting AAA bondholders harder than they were hit. On the other hand, there are pro-cyclical factors that we go into in the book, but that I didn't have time to go into here, such as mark-to-market accounting, which probably made this crisis happen. There often are market panics over when new information comes out and people think about what are the implications of this information. So when subprime mortgages began defaulting at a higher than expected rate, investors in mortgage-backed bonds began selling them. Mark-to-market accounting forced banks to mark down their profits and losses, according to the temporary market value of these bonds, even though the real value of the bond is what it pays off over its lifetime. So when Lehman Brothers went bankrupt, there was a real market panic, and this almost certainly required banks, the markdowns required by law, almost certainly required banks to massively contract lending. That, we think, caused the recession, and that in turn caused a lot of would-be mortgage defaults that wouldn't have happened otherwise. So on the one hand, you have this other regulatory factor, mark-to-market accounting, that may have touched off the crisis to begin with. And then you have the bailouts that kept people who would have had to default on their mortgages from defaulting. And the net result is that AAA bondholders got pretty much what they expected, 99% of the revenue that they expected from the bonds. There's no way of telling, since we can't rerun the world and control this experiment, there's no way of telling in that case whether these ratings really were inaccurate or not. So it may be that this SEC created cartel of the three rating agencies was responsible for the crisis, and it may be that their ratings actually weren't so far off after all.
Okay, I think there's a follow-up to that one. Is there any truth to the story that these AAA bonds were actually package deals of a set of the low and high risk bonds?
Yeah, there were derivatives is a confusing term because it means many different things, but one of the things that is meant by the term is CDOs, which were a type of mortgage bond that pooled together other mortgage bonds, so pools of mortgage bonds. Each mortgage bond itself then has a pool of mortgages behind it. So because, I think, because of the regulatory favoritism toward highly rated mortgage bonds, the parts of mortgage bonds that were rated lower than banks could invest in then got repackaged. Now, so it sounds like a scam. You're taking triple B or double A or single A mortgage bonds and repackaging them into triple A mortgage bond. How can that be? But the answer is this contractual structure that I referred to. Even when you have a group of mortgage bonds that's serving as the collateral for your bondholders, that set of mortgage bonds and the underlying mortgages, all the revenue from those mortgages still goes to the AAA CDO bondholders first. So it really is an ingenious system for guaranteeing not necessarily the accuracy of the ratings, which has to do with how much money, the exact amount of money can be generated by all the mortgages or other assets in this pool, but it is an ingenious way of making sure that AAA bondholders really are safer than AA bondholders, who are in turn safer than single A bondholders. No matter what the rating of the underlying bonds was, the structure is the same, so that a AAA derivative bondholder still is entitled to get paid off before any AA bondholders are, so it still is a safer investment than a AA investment is.
Okay, thanks. Our next question was JP Morgan Chase penalized for not investing in mortgage-backed bonds?
Well, any bank that didn't, I mean, in the limit case, banks could have invested, could have escaped all penalties under the Basel 1 and 2 system by investing solely in government bonds. No capital was required to hold government bonds. Under Basel, that was the Basel 1 system. The Basel 1 system was never changed in Europe, and so if you're looking for an explanation for the European sovereign debt crisis, the next issue of Critical Review is going to have an article about this. So the only way that a bank could entirely escape the penalties of capital regulation was to invest solely in government bonds. If a bank invested in individual mortgages, it would get penalized compared to if it had invested in government bonds. And if a bank invested in businesses, it would get penalized compared to if it invested in mortgages. Then if a bank sold its mortgages and then bought them back in the form of a mortgage-backed bond rated AAA or AA, it would be penalized less than if the bank held mortgages. So there were 4 risk categories, according to what the regulators thought the risks were. Government bonds were rated as a 0 risk, and therefore there were no penalties for investing in them. AAA and AA rated mortgage-backed securities were considered a 20% risk, so the penalty, meaning the amount of capital that a bank had to invest in order to buy a mortgage-backed bond, was only 20% of what it would have had to invest in the business. Mortgages, individual mortgages, were considered half as risky as business investments, and then there was business investing. So any bank, all banks, no matter how reckless and greedy, they all have a mixed portfolio of all these different sorts of investments. One of the factors that they have to take into account is the penalties for ordinary investments compared to the investments that the regulators singled out for special treatment, which were mortgages, mortgage-backed securities, and government bonds. So the short answer is yes, JP Morgan was penalized for not investing in mortgage-backed bonds. Citibank was also penalized to the extent that it didn't invest in mortgage-backed bonds, but it invested in more mortgage-backed bonds than JP Morgan, so therefore it was penalized less.
Okay, thank you. Our next question, would increased reserve requirements have increased stability in the banking system?
I'm going to assume that the question is sort of based in Austrian business cycle theory, and in that case the answer is I don't know, but that's not the kind of regulation that I'm talking about. What I'm talking about are capital regulations, not reserve requirements. Capital regulations have to do with the type of funding that banks have behind the loans that they make, not with how much money they lend out. I couldn't tell you, actually, having forgotten it already, how reserve requirements work, but these are not reserve requirements. These are capital requirements.
Okay, our next question. It seems like incentive type arguments are downplayed, but what can we say about the regulators penalizing business investments as opposed to mortgage loans as something else other than an incentives kind of argument?
Well, I think there may be a case. I've seen one reference in the literature, not the literature like the theoretical economics literature, but literature by people who actually were involved in the regulatory process. I've seen one reference in a book whose title I forget, but it's a chapter by Jean Rocher, I think, who claims, without any substantiation, that the initial favorable treatment for mortgages in the international Basel rules was pushed by American regulators. Now that might be due to political pressure or perceived political pressure to treat mortgages, to give special treatment to mortgages, because in America owning a home is or used to be anyway, sort of ideal. But I haven't seen any actual research about that as opposed to just the assertion that Americans were responsible for this international favorable treatment toward mortgages. But although I think that treatment probably did contribute to the crisis, what actually got the banks in trouble apparently was not the individual mortgages that they had, but the mortgage-backed securities. And the mortgage-backed securities were not treated specially just because it was mortgages that were backing them. There were also asset-backed securities where the underlying collateral was credit card debt, student loan debt, and these were treated just the same as by the regulators as if they were backed by mortgages. Any asset qualified for the special treatment by the regulations. So I don't see any a priori reason to think that there was anything nefarious about that. And even with the treatment of mortgages, the theory that's enunciated in Basel regulations themselves is that mortgages are safer investments than business loans because people don't generally, or it didn't used to be at least, that people took out mortgages for speculative purposes as opposed to living in a house. Whereas businesses are inherently speculative, and therefore I think a legitimate argument could be made back then that mortgages were in some, to the extent that there's any such thing as objective safety, that they were objectively safer than business loans.
Okay, we have another question about ratings. Are the rating systems on the stock market? If so, would there be a reason to skew the ratings for gain? I know you mentioned that AAA ratings earn less, but at a high volume, could these still generate a substantial profit?
Oh yeah, they did generate a substantial profit. I don't know that the profit would have been any different if Standard & Poor's and Moody's and Fitch had been privately held rather than publicly held companies. But there was so much demand from all sorts of institutional investors, including banks, for highly rated mortgage-backed bonds that the ratings companies made a fortune by rating them. Now, whether, the easy incentive story about that is, okay, so AAA ratings are what was in demand, so they responded to the demand by knowingly rating bonds that shouldn't have been rated AAA, or in this case, actually, it's a question of how many people who invest in a mortgage pool get a AAA bond as opposed to a lower-rated bond. But there's actually no evidence of that. It might have happened. It might have happened to some extent. It might have happened at one of the three rating companies or two of them. But these are big organizations with lots of people doing lots of ratings, and I honestly don't know what effect the incentive had. But the real question is whether the ratings were inaccurate, and whether, from a political theory perspective, people always have incentives under capitalism to shade the truth. It might make money if you shade the truth, if you engage in false advertising, and so on. And that does happen. The only remedy that capitalism has for that sort of thing is competition. If, in fact, either just human error or the incentives to give high ratings to the bonds led the three mortgage companies, bond rating companies, to give inaccurate ratings, the remedy under ordinary capitalism would be competition. But the SEC had been preventing that competition from happening since 1975. So I do downplay incentive stories because there are so many economists in the world who tell those stories. I'm trying to broaden and improve the accuracy of our picture of capitalism by including other factors, epistemological factors. But these epistemological factors are tied directly to the advantages, if there are any, of capitalism. If companies are misleading people who use their services, generally speaking, it's possible for there to be a competitive remedy. there were people at the ratings agencies. I discussed this in both the book and both of the books on the financial crisis. There were disgruntled employees who thought that they were going about this all wrong, that they weren't being careful enough. And people like that could have started rating agencies in competition if they'd been allowed to. Now, coincidentally, just before the financial crisis, Congress passed an act that sort of deregulated the rating agencies. It required the SEC to certify more companies as nationally recognized raters than they had been before. And so, sure enough, a couple of competing rating agencies have gotten started since then. But the market for mortgage-backed securities obviously has vanished, so it's hard to tell whether they would whether they actually would give different ratings for these securities than the big three would.
Okay, our next question. What is the after effect of financial crisis in terms of the role of government? Is there a change in policy, either fiscal or monetary, in order to boost up the economy?
Well, sure. There's been a huge change in policy, or at least there's been a huge amount of policy. This isn't a story that we go into, or that my research has gone into, because I was interested only in what caused the financial crisis, and ultimately I was interested in the question of whether capitalism can be held to be responsible for the crisis. The response to the crisis is a different thing, and I honestly don't have an opinion about whether once the elements of the crisis were in place, including both these regulations encouraging mortgage-backed security investment among banks and also mark-to-market accounting is applied to banks, then you have a real problem on your hands, and whether there should have been all sorts of bailouts and other policy activism, I couldn't tell you. I do think that there's a larger point, which is that I can tell you firsthand that the scholarship on the crisis, it's really amazing for me as a political scientist to have buried myself in these papers written by economists, even though I've been very sympathetic to Austrian economics all my life. And I heard from Austrian economists like Pete Boettke that economists tend to assume that everybody is omniscient. I didn't really see it in action until I started reading all these economist papers and doing research on the financial crisis. On the other hand, something that I think is not sufficiently criticized about economists is that it's as if they cannot think about an empirical question without trying to reach a policy conclusion. And I think that skews the research. The research only continues in the mind of the economist until the point when he can reach a policy conclusion. One of the things that critical review has steered away from all these years, its almost 25 years of existence, is policy debate, because it is done by everybody else. And frankly, nobody cares what any of us thinks about policy, so why are we constantly thinking about policy implications? I think it's much more interesting to think about reality. What is the reality? What can be said to be the causes of the crisis in this case, rather than what should we do about it? So that's just one of my pet peeves, which is that economics can infect all of us as citizens or as libertarians into constantly thinking about what should be done, what shouldn't be done, rather than about what has happened or what will happen. I don't know what would have happened without the bailouts, so I don't know whether I should be for them or against them, but frankly nobody except right now, nobody's ever asked me for my opinion about it, so it doesn't really matter what I think about that, and that's really the case of most of us. But as human beings who are interested in our political opinions being true, it seems to me that the more important question is not what government should or shouldn't do, but what were the effects when government did this or that. I don't know what the effects were of the government's responses to the crisis. I do think I know, at least tentatively, that the government inadvertently caused the crisis.
Okay, it looks like we have time for one more question. What are the systematic conclusions that should be drawn from the facts that you have recited? What rearrangements could be made in the banking and housing industries to avoid similar incidents in the future?
That's sort of, I was glancing at that question as I gave my little spiel about the dangers of policy thinking. Not that there's anything wrong with thinking about policy or asking about policy, and maybe ultimately the only reason we want to know about reality is that we want to know what to do about it. But the short answer is I don't know. How should things be rearranged? I don't know. One of the nice things about capitalism is that, although it's also a rhetorical disadvantage of capitalism, is that we don't know how competition would arrange things if there were unregulated competition. The housing industry and the banking industry are so shot through with regulation that it's anybody's guess what it would look like without the regulation. Another astonishing thing about doing this research is just trying to read and understand a fraction of the regulations that are in the Federal Register covering banking. It's a monumental task, and most economists who write about finance don't even know about some of these regulations because there are so many of them and they're so complicated. So I really don't know the answer to that type of future prediction question. I can say I think that as a result of the financial crisis, whether this was an appropriate response once the crisis happened or not, now too big to fail really is a problem. We actually give evidence in the book that too big to fail was not a problem prior to the crisis. In other words, that bankers and the investors in banks were not assuming that banks would be bailed out the way that they did assume that Fannie and Freddie would be bailed out. So it turned out that both banks and Fannie and Freddie were bailed out, but the bankers didn't know that beforehand, and it didn't seem to skew their behavior, contrary to the notion that it did. But now it would be unbelievable if their behavior was not skewed by that, because the Dodd-Frank bill basically says big banks will be bailed out, and in exchange, here's what you have to do in order to be safe banks. It's an extension of the same type of regulatory mindset that has been applied to banks ever since the Great Depression. But now it's written in stone that big banks, systemically important banks, will be bailed out. That's what the definition of systemically important means in terms of policy. So that's got to be having an effect, I would think, other things being equal, on the structure of the banking industry. Whether that effect is that banks want to be too big to fail, and so it's increasing concentration in the banking industry, or whether banks don't want to be subject to the Dodd-Frank regulation and therefore are shedding assets so that they don't hit the systemic limit. I've seen journalism pointing in both directions, so I don't know what the effect is, but undoubtedly there is an effect. Let me just, since that was the last question, say that if people want to find out more about critical review or about these two books, that one of which is a special issue of Critical Review republished by the University of Pennsylvania, and the other is just an original book. The thing to do is to go to Facebook and find the Critical Review friend page. It's not a public figure page, it's an actual page. So send a friend request into Critical Review, and then we will accept the request. And then you'll be able to see on that page, if you click on the photos, you'll be able to see information about all the books, about how to subscribe to Critical Review, or how to persuade your librarian to subscribe to Critical Review.
Okay, well, thank you so much, Professor Friedman, and to all of our participants this evening. We apologize if we couldn't get to your question, but please feel free to continue the discussions with other participants on the Facebook event page. I hope you can all continue coming back to our webinars to learn more throughout the year. Stay tuned for the announcement for our April webinars tomorrow, and you can find it on our website at studentsforliberty.org. On a final note, shortly you will receive a follow-up email where you will find more detailed information about SFL in our next webinars. You'll also receive a survey to evaluate the webinar. Please take a couple minutes to fill it out. It helps us know how to improve our webinars and makes these lectures more interesting for you. And with that, I think we're officially wrapped up. Thank you again for your time this evening, and have a wonderful night, everyone.
The organizer has ended